I have an investment opportunity that can generate a potential return of close to 60% in less than a year. Pay close attention because the devil's in the details. The reason for this massive discount has nothing to do with the actual business itself, but the likelihood of a buyout going through. And the crazy part, if the buyout doesn't go through, that might provide the better investment opportunity. Let's dive right in. For those of you who want a deep dive Wall Street insider analysis, check out my school community. The link's in the description. 4 points that I'm going to cover in this video. Number one, background/business model. Albertsons is an operator of 2267 grocery stores across 34 states and under 20 different brands. So if you haven't heard of Albertsons, perhaps you've heard of Safeway, Tom Thumb, King's, or Acme, just to name a few. Part two, the opportunity. 2 years ago, in October of 2022, grocery store competitor Kroger, the largest grocery store chain in the country, offered to buy out Albertsons. The offer was for $34.10, which represented a 32.8% premium and would be broken into $27.25 cash and a special dividend of $6.85. The special dividend totaled $4 billion and was already paid in November of 2022, leaving the remaining $27.25 to be received by Albertsons shareholders. Part three, deal update. So Lena Khan of the FTC has held up the deal and it's currently in review. It should be resolved soon, but I cover all the potential outcomes, so stay tuned. Part four, valuation. On Wall Street, we build three-statement financial models culminating in a discounted cash flow or DCF valuation. I've built a three-statement model with a DCF for Albertsons and feel that it provides a unique opportunity for an almost 60% return. Let's dive right in. If you're enjoying this, please smash that like button. All right, company background. Imagine a grocery chain that started with a single store in Boise, Idaho during the Great Depression. Today, it spans over 2,000 locations. What's the secret behind Albertsons' growth, and how has it remained competitive for over nearly a century? So founded in 1939, Albertsons has grown to be a leading U.S. food and drug retailer. It operates 2,267 stores across 34 states under brands like Safeway, Vons, and Jewel Osco. The company has a number one or two position by market share in 70% of the 121 metro areas in which they operate. In addition to grocery stores, they also operate 1,726 pharmacies, 1,330 coffee shops, and 405 fuel centers. They serve 35.3 million customers per week on average. That is 1.84 billion customers served per year. Their core focus is customer service, community engagement, and expanding digital channels. They have significant philanthropic efforts, including a $350 million contribution in 2023. Business model, so how do they make money? Think about the last time you shopped at a grocery store. Did you ever wonder how these stores make money beyond just selling food? Albertsons has a few tricks up its sleeve beyond aisles and checkout lines. Let's see what makes Albertsons profitable. So the company primarily earns revenue from in-store sales, supplemented by digital and omni-channel strategies. They have extensive pharmacy operations, which contribute significantly to revenue. Albertsons Media Collective monetizes advertising with the shopping experience, and growing digital sales up 24% in the recent quarter. With a loyalty program of 43 million members, this drives more frequent customer engagement and higher spending. In terms of the revenue breakdown, 50% comes from non-perishables. These are general merchandise, grocery, dairy, and frozen foods. 32% comes from fresh, which is produce, meat, deli and prepared foods, bakery, floral, and seafood. 11% comes from pharmacy, 5% comes from fuel, and 2% comes from other, which includes wholesale revenue to third parties, commissions, rental income, and other miscellaneous revenue. So how is the business currently doing? So Albertsons' latest quarter had some interesting surprises for investors, from digital growth to challenges with fuel sales. So let's break down what investors need to know. Sales of $18.6 billion plus 2.5% in identical sales. This is also known as comparable or same-store sales, with strong contributions from pharmacy and digital sales. Profit margin. So gross margin held steady at 27.6%, with digital expansion adding to sales but impacting costs due to rising delivery expenses. Now, bottom line, they generated $146 million in net income with adjusted earnings of 51 cents per share. So there have been profitability challenges, including rising labor and operational costs. So what's the investor takeaway? Growth in loyalty members and digital sales is promising, but costs from labor and merger-related expenses are pressures to watch. We're going to get into that in a little bit. Now, while grocery stores are not nearly as interesting as AI, I'm looking for great investment opportunities. I don't care the industry or the sector, but the return potential. More good news. AI is not going to put grocery stores out of business, because online shopping and delivery has actually helped the business tremendously. So what is the opportunity? While we may have a different ending, the buyout of Albertsons is not a new story. It's actually the same story, but it might have a different ending. Way back in 2006, private equity firm Cerberus took Albertsons private in a leveraged buyout or LBO, where an investment firm uses debt to buy out the shares of the company. While LBOs tend to last 5 to 7 years, the global financial crisis caused a change in plans, and it was not until 2015 when Cerberus considered an IPO for the company to be able to cash out. Finally, in mid-2020, Cerberus was able to complete a downsized IPO of Albertsons, valuing the company at $9.3 billion, or $16 per share. This was below the $18 to $20 target, and Cerberus owned 31.9% post-IPO. Today, Cerberus owns approximately 26% of the outstanding shares of the company, worth almost $2.8 billion. So what's the takeaway? When a financial sponsor or private equity firm buys a company, there's no antitrust concerns because the business concentration or market share is not increasing. When we buy shares in a company, we're not increasing the market share of the company because we're not in a business operating in that space. So it's the same logic. Now, on October 13th, 2022, grocery store competitor Kroger, the largest grocery store chain in the country, entered into a merger agreement with Albertsons to combine the two businesses. The offer was for $34.10, which represented a 32.8% premium and would be broken into $27.25 cash and a special dividend of $6.85. The special dividend, totaling $4 billion, was paid in November of 2022, leaving the remaining $27.25 to be received by Albertsons shareholders. Now, the combo of the number one and number two grocery store chains presented concentration issues. The companies planned on divesting of stores because they knew that there would be competition issues in certain markets. So part 3, the deal update. Enter Lena Khan, the head of the Federal Trade Commission, or FTC. So she has an antitrust focus. She's known for her aggressive stance on antitrust issues, especially in large corporate mergers, which she argues can harm competition and consumers. Critical eye on the grocery sector. So Khan has emphasized the need for competitive markets in essential industries like groceries, where reduced competition could lead to higher prices. Scrutiny of market power. Under her leadership, the FTC is carefully examining if the merger would create excessive market power, particularly in local areas where Kroger and Albertsons are both dominant. Potential for blocking the deal. Khan's approach suggests she may support blocking the deal unless Kroger and Albertsons make substantial concessions, like selling off significant assets to preserve competition. So to satisfy regulators, the company planned on selling 413 stores to C&S Wholesale Grocers for $1.9 billion after the FTC sued to block the deal in February 2024. The company added an additional 166 stores to the divestiture, increasing it to 579 stores for $2.9 billion of value in April 2024. Now, even if they make it through the FTC, the deal is not a slam dunk. Legal challenges. So there are state-level lawsuits. Several state attorneys general have raised lawsuits challenging the merger, arguing it could lead to reduced competition and harm consumers, especially in rural and underserved areas. Pending court cases. So these state-level legal battles are ongoing and may require court judgments to be resolved. While some lawsuits seek to block the merger, others focus on requiring additional commitments from Kroger and Albertsons to protect competition. Timeline for resolution. So regulatory review timeline. Right now, the FTC review and state lawsuits are expected to conclude between late 2024 and early 2025. So what are the possible outcomes? It could be approved with conditions. So the FTC may permit the merger with conditions like divestitures and additional commitments to maintain fair pricing. Now, if the merger proceeds, there's potential for scale efficiencies, improved bargaining power, and expansion of omni-channel capabilities. This could be transformative for Kroger and Albertsons, likely reshaping the grocery market landscape. Now, what if the deal is blocked? Albertsons will likely need to continue independently, focusing on enhancing its digital and in-store experience to compete with rivals. So if the merger fails, Albertsons may face competitive pressures from standalone operating costs and potential investor uncertainty. But there is an opportunity to focus on digital and loyalty initiatives, continuing on a standalone strategy that has driven recent growth. Now, while they are still awaiting FTC approval, Albertsons stock has floundered and recently has gone down below $20, recently closing at $18.01. This is a sign that the deal is less likely to go through. Now, buying the stock of a target company after a buyout deal has been announced is known as merger arbitrage, and it is predicated on the deal receiving regulatory approval. Now, merger arbitrage is a hedge fund investing strategy, which I cover extensively in my school community, Win Like Wall Street. Click the link in description to check it out. So a famous recent example of merger arbitrage involved Microsoft's $69 billion purchase of Activision Blizzard for $95 per share in late 2022. The stock traded down to the low 70s, and Warren Buffett built up a 9.5% stake. After 633 days, the deal finally closed in October of 2023, providing a nice payday for Buffett. Never forget, in the words of our old pal Warren Buffett, price is what you pay, value is what you get. So since the announcement of the Kroger deal, Albertsons has continued to grow. It has kept costs in check despite inflation, yet the stock price has gone down. You're not going to see eye-popping massive growth from a business like this. It's a grocery store. But here's the good news. Steady equals predictable. The stock is trading based on the likelihood of the deal going through at $27.25. And if you buy it at 18 and it does go through, you get a nice 51% return. But if the deal does not go through, that might present an even more lucrative opportunity because the stock has grown in value in the past 24 months since the deal announcement in October of 2022. Part 4, the moment we've all been waiting for, the valuation. So we're going to begin with the balance sheet. So not like the tech companies that we have seen in past videos, but inventories have been stable through COVID with a 5-year compound annual growth rate of 2.7%. Now, while it's working capital intensive, it is not CapEx intensive. So over the last 5 years, the company has had a net pay down of $2.5 billion of debt. While cash is only about $200 million, it is projected to 10x over the next 2 years based on our model. The company has had almost $3 billion of cash at the end of 2021, but paid a $4 billion special dividend as part of the Kroger merger in 4Q22. In February of 2023, the company closed on a revolving credit facility with a limit of up to $4 billion. Think of like a credit card, but for companies. They drew $1 billion to help pay the special dividend. In addition to the nearly $3 billion of cash on hand that they had, we're going to see this in the cash flow statement. So what's the takeaway? While the company has over $8 billion of debt, the business is very stable, steady, and able to handle the leverage. Let's hop in the model. All right, so as we mentioned, the company had a lot of cash on hand prior to paying that special dividend as part of the merger. Their inventories have been stable over the last 5 years. Their PP&E doesn't rise that much. This is not a capital-intensive business. It is a working capital-intensive business. When we talk about working capital, we're talking about accounts receivable, inventory, and accounts payable. If you look at their debt, it has come down over recent years, but it still is over $8 billion, something to be mindful of. So overall, we see a solid balance sheet for this company with nothing going too far out of whack. All right, next we have the income statement. So top line revenue growth has achieved a 5.5% rate over the last 5 years, while net income has increased more than 10x that rate over the same 5 years to the tune of 58.1%. This is indicative of a very efficiently run business with massive operating leverage. Remember, revenue is what you make, net income is what you keep. Margins have expanded across the board, which means that as revenues have grown, costs have grown at a slower rate, so they're keeping more money in their pocket. Now, despite rising interest rates, the company has done a great job keeping interest expense under control by locking in low fixed rates in and around COVID when rates went to zero. Now, remember this, at the end of Q2 2024, Albertsons reported total merger-related expenses of approximately $252 million. In the most recent quarter alone, Albertsons reported $67.4 million in merger-related expenses. So this includes third-party legal fees, advisory fees, ongoing costs due to regulatory compliance, and retention programs designed to maintain employee engagement. The reason I mention this is despite these costs, Albertsons has maintained solid profitability. And whether the merger goes through or not, these costs will disappear, offering more net income for investors. So what's the takeaway? Growing revenues, cost control despite inflation seen in the expanding margins, and positive operating leverage gives us a very well-run company despite a tough business environment. Let's hop in the model. All right, so as we mentioned, 5.5% increase in revenue over the last 5 years, but a 58.1% increase in net income over the last 5 years. The company has kept interest expense under control. You see that it's actually declining over the last 5 years, which is pretty impressive. Also, the company has very robust retained earnings, which is increasing over time, which is something we like to see. Next, we have the cash flow statement. Free cash flow has doubled in the last 5 years, and operating cash flow has increased almost 60% over the last 5 years. This is not a high cash flow business, but a growing, steady cash flow business. The company has generated $3.2 billion of free cash flow over the last 3 years. You will see the $4 billion special dividend the company paid at the end of 2022. Now, the company has been paying dividends on common stock since its IPO in 2020. So what's the takeaway? The company has positive trajectory with large potential upside. Let's hop in the model. All right, so as we mentioned here, free cash flow has grown 93.1%, almost doubled, and operating cash flow has grown almost 60%, both over the last 5 years. One of the things that we see is net cash from operations or operating cash flow is steadily increasing. It's not massive growth, but it's steady and consistent. Also, we don't see a ton of capital expenditures, but we do see a relatively flat rate. You're going to see later on when we cover the assumptions, it doesn't waver too much. It's inside a very tight band. Also, we see the special dividend of almost $4 billion in 2022. And as mentioned, since they IPO'd after coming out of the buyout from Cerberus, they have been paying a dividend since 2020. All right, forecast drivers and DCF assumptions. I am using a very, very conservative 1.5% top line revenue growth rate. EBITDA margin works out to be only 5% in the projected years, which is below the 3-year average of 5.2%. We have a very low beta for this company of 0.45. It's not a volatile business, unlike our recent tech analyses. Now, there is significant leverage, 43% of total capital, but it is very manageable and it reduces the weighted average cost of capital, which increases our valuation. We're going to see this next in the discounted cash flow. So what's the takeaway? Conservative assumptions are going to give us conservative results. Let's hop in the model. All right, so if we look at our forecast drivers here, you can see over the last 5 years, a 5.6% average top line revenue growth. I went down to 1.5%. Wall Street has 1.7%, so we're being like super, super conservative here. Also, you see cost of goods sold, a very, very tight band here. We go with 72%. SG&A as a percentage of sales, so these are overhead employee costs. That's the thing that's remained very consistent as well, so we went with 23%. And then ultimately, when you look down here at the debt pay down, they're going to have to pay down about $4.7 billion over the next 5 years, with 26 and 27 being particularly challenging, yet they still are keeping their heads above water in those instances, and the company is still very well functioning. All right, next we come over to our DCF assumptions. So we see a very low beta, which results in a very low cost of equity. We have a post-tax cost of debt of 4.62. Something to be mindful of. They do have a junk credit rating of BB+, and that's because they have very high leverage right here, 43%. That does result in a very low weighted average cost of capital because the cost of debt is less than the cost of equity. So the more debt a company has, ironically, the lower their weighted average cost of capital. So this is going to ultimately boost the valuation for the company. One of the other things to be mindful of, they have increased their cash over the last 6 months. So they have $280 million as of the end of this current quarter versus $200 the end of last year. Now, one other thing to focus on, again, being very conservative with our assumptions here. If you look, I use a 5 times terminal EBITDA multiple. The comps are trading at 9.9 times. The current EBITDA multiple for Albertsons is 5 times. It's very depressed, and it's a function of the fact of the likelihood of the deal going through, not the operations of the company. If you look, we have the last 14 quarters. Albertsons EBITDA has ranged from 4.2 to 6.3 with a midpoint of 5.25 and an average of 5.22. So going with 5 is going to give us a super conservative result, and prepare to be surprised because even with this very conservative assumption, we're going to get a pretty remarkable result. All right, DCF valuation. We ran 3 scenarios at bear, base, and bull with the current model at base. Remember, future cash flows are discounted back to today to get to total enterprise value. We strip out net debt to get to equity value. This company has low, steady, predictable growth, but is it worth buying today? The stock is down 21% year to date. Wall Street has Albertsons with a median of $24, which is a 31% discount. But what does our analysis show? Let's hop in the model. All right, y'all, DCF time. Woo woo! So we got EBITDA less DNA gives us EBIT less cash taxes, gives us EBIT or NOPAT. We add back the DNA. We take into account changes in operating working capital. We strip out the CapEx. That gets us FCFF or free cash flow to the firm. Remember, we have 5 times terminal multiple, 5 times EBITDA. We get our cash flows to discount. We multiply that by the discount factor. We get our present value of cash flows. We add those together to get our total enterprise value. We strip out debt. We add back cash. We strip out non-controlling interest. We add associate investments. We get an intrinsic equity value of about $16.5 billion. Divided by the current shares outstanding, we get an implied share price of $28.45 compared to the current close of $18.01. That is a 58% discount, which is a screaming buy. All right, sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth versus CapEx intensity and WACC versus the terminal multiple. 0 out of 50 or 0% showed a sell rating. 0 out of 50 or 0% showed a hold rating. 50 out of 50 or 100% showed a buy rating. At a 5 times terminal EBITDA multiple, the stock is about $28.50, which is a 58% discount. We ran each of the 3 scenarios equally weighted and got a weighted average value of $28.60, which is a 59% discount. So utilizing conservative assumptions, we show a solid buy rating for the stock with a massive discount of almost 60%. Let's hop in the model. Guys, green everywhere. It's like a St. Patrick's Day celebration. The reality here is we have super conservative assumptions. Remember, we had 5.5% 5-year revenue growth. We're going with 1.5%. Wall Street has 1.7%. So these are super conservative assumptions. CapEx intensity. Their CapEx has ranged from 2.2 to 2.8%. We show a range here of upwards of 3%. And even in that scenario, it still shows an incredible buy rating. The terminal multiple of 5 times is super conservative. Kroger is currently at 6.5 times. That's the company that's buying them out. Yet, if we go down to a terminal multiple of 4 times, which would be lower than the lowest multiple they've ever had, we still show a buy rating. So ultimately, you got to really seriously consider this company. Okay, scenario analysis. We equally weighted the 3 scenarios, bear, base, and bull, and we showed the same thing. In a bear scenario, we show a sell. We already have super conservative assumptions. I find the likelihood of that bear scenario happening being very, very low. Right now, technically trading at $18, that is a bear scenario in and of itself. The base case, we get a 58% discount. There's a bull case scenario where we get a 158% discount, which is just bonkers. But ultimately, we see about a $28.60 valuation, which is almost a 60% discount and a screaming buy rating. All right, the wrap up. Wall Street has a high of 27.25, which is a 49% discount, a median of 24, which is a 31% discount, and a low of 17, which is a 7% discount. Our analysis showed a value of around 28.50, which is almost a 60% discount. The stock has shown a slow decline since the payment of the special dividend in November of 2022. Now, despite trying to appease regulators with the sale of 566 stores for nearly $2.9 billion, it's still not clear if regulators will approve the deal. I don't see anything happening between now and the election, but it looks like there's going to be a conclusion by year end. Ironically, if the deal does not go through, that might provide a better investment opportunity. Now, you should seek the advice of an investment professional always. I do not know your individual financial situation, and this content is meant to educate and is not investment advice. That being said, I must tell you that Albertsons is one of my largest portfolio positions with a weight of 10%. This is a rare and unique win-win scenario where the deal not going through may provide higher upside than the current $27.25 offer price. As the number 2 grocer in the United States of America showing steady growth, cost control, and conservative management, Albertsons is a stock that you should check out. If you want a deeper Wall Street insider analysis and to get direct access to me, check out my school community. The link is up in the description. And if you like this and want to see another stock analysis, check out my Meta video here or my Alibaba video here. And if you found this valuable, please share this with someone who you think would enjoy this. And as always, be relentless.